The three fund portfolio is one of the best known portfolios out there. You have the Boglehead three fund portfolio that makes up total US stocks, international stocks, and bonds, and together that creates a kind of a lazy portfolio for those people that want to set it, forget it, and then at the end of retirement you have money left over. And that's just something that people want to use, and it makes sense because first of all, you don't really have to think about it. You put in your percentages, you do it, you set it, you forget it, you rebalance at the end of each year, and boom, by retirement, you have a good portfolio that can create income, and it's probably grown over the last couple years. And the way it does this is it balances things out. Not every year will the US market dominate. Not every year the international market would dominate. And sometimes you also need some fixed income from bonds. And that makes sense. But in today's video, we're going to talk about a modern approach to the three fund portfolio. We're not going to just think about just international stocks and how they've done quite poorly over the last 10, 15, 20 years. We're not going to look at bonds because maybe we are young and we may not need bonds, or we can maybe see an alternative to bonds that could probably help boost our portfolio and give us some good income. And we're also going to talk about, a good broad market ETF, kind of like VOO or VTI. Now, hey guys, my name is Steve and I run the Frugal Expat website where we try to help people to save more and invest better. And today we're talking about some investing better. So if you like this content, make sure to hit that like button and subscribe. And we'll continue to create great content to help you to do better. Now, like I said, we're talking about like a modern approach to the three fund portfolio. In the last couple years, international funds have done poorly. It's averaged about 5% per year, while the US stock market has done anywhere between 11 to 15% per year. And that's just, wow, that's like a lot of money being left on the table. Bonds, on the other hand, gives a fixed income, and it has averaged about 2 to 3% per year, and that's including its dividends, which is quite poorly. And so we're trying to look at a modern approach to figuring out how can we create a three fund portfolio or four fund portfolio or even a two fund portfolio and beat the market, or just be able to set it, forget it, rebalance at the end of the year, and continue to grow it until we hit retirement. Now, that is just something that I want to kind of point out to, and we are going to start off with a couple of different ETFs and funds to make this happen. First of all, we're going to have a core position, and this is going to be a broad market ETF. And you can start off with the S&P 500 ETF, VOO. Now, VOO is a great S&P 500 ETF. It holds about 500 different holdings. It's got an expense ratio of 0.03%, and it's got a dividend yield of about 1.4%. So the yield's not that great, but that's okay because we're not looking for a yield in this ETF. We're looking for a good core position to hold in our portfolio. Now, if we take a look at Seeking Alpha, we can take a look at some of the things that's going on with this ETF. So let's take a look. All right, we're going to take a look at VOO from Seeking Alpha. And as you can see, 1 year's pretty good. Year to date is not as good, but that's okay. Markets go up and down, and this is just part of it. Now, if we can take a look at this momentum, like I said, the 1 month hasn't been so good, but 6 months, 1 year, 3 years, 5 years has been excellent. And if we take a look at the holdings, we have about 32% in technology. We do have financials, consumer cyclical. We've got healthcare, consumer defensive. We got a good broad-based portfolio right here. Our total holdings is going to be, we've got Apple, Microsoft, Nvidia, Amazon, Meta, some of the Mag 7 right here, including some Berkshire Hathaway and Broadcom. And it's just a good, well-balanced portfolio with about the top 500 companies in the US. Now, if we want to take a look, kind of look at the charting just to see how this compares to, another good broad-based ETF, which is going to be VTI. So let's make sure we have our metrics correct. I like to look at overall performance instead of price performance. So the total return, that's including the dividends reinvested. That makes it just kind of much better. And if we added VTI, which is the Vanguard Total Stock Market Index Fund ETF, that's just a great ETF to add to your portfolio. So if you don't want VOO, VTI could be just a much better alternative. So when we take a look, we can see in the 1 year, they're kind of on par with each other, which is great. Let me just remove this S&P 500. So this is great. So if we take a look at 3 years, VOO is doing much better than VTI, but that's kind of expected. It's VTI's got a little bit of mid caps and small caps a part of it. 5 years, you can see that VTI is doing a little bit less, but that's okay. They're still not bad. I mean, they're still neck and neck. 10 years, VOO has surpassed it by not so much, about maybe 20%, but that's just compounding over the years. So these are just two great ETFs that can be added to your portfolio. And one of the things I like about both VOO and VTI is it's a great core to add to your portfolio. So when things go up and down, this is just something that kind of holds it together. Now, if we wanted just a little bit more growth, and to add to this portfolio, one of my favorite ETFs is VGT. Now, I've talked about VGT several times on this channel because I think it's a great ETF. It's been around since 2004, so it's been around in the ups and downs of the market, and it has been held strong compared to many other different ETFs. Now, it is quite heavy into tech, but if we look at it, it's got about 316 different holdings. The expense ratio is 0.09%, and it's got a dividend yield of about 0.6%. The dividend yield is quite low, but we're not looking for dividends. We're looking for growth when we're adding this to our modern approach 3-fund portfolio. And that is just one of the great reasons of having VGT. It's going to add that growth element. Now, if we take a look at Seeking Alpha, we're going to take a look at kind of the holdings. We're going to take a look at the performance and even one of the other ETFs that you can compare VGT to. So let's take a look at Seeking Alpha. All right, so when we get down to Seeking Alpha, we're going to be looking at VGT. And if we take a look at the summary of VGT, you can see that, it's got a low expense ratio. The yield right now says is sitting at 0.61%. The year to date is a little bit negative, but that's okay. The market has been down and, these things happen. But if we look at 1 year, 5 years, 10 years, it has been doing pretty good. Now, if we take a look at the holdings, as you can see, 99% is in technology, and that makes sense. If we take a look at the top 10 holdings of this, we have Apple, we have Nvidia, we have Microsoft. Now, these three holdings are making up about 40%. Broadcom is helping bring it up to 40 to 50% of this ETF. Then we have Salesforce, we've got Cisco, we've got IBM, which is a great great business, and this makes about 58% of this ETF. Now it's got about 319 different holdings, and if we take a look at kind of the charting and seeing where's this ETF going, and we can tell that it has been beating the S&P 500 with this is probably the price. So we take a look at more of the performance, the total performance, instead of just the price return. It's got dividends reinvested for the long term. VGT is skyrocketing past S&P 500 over the last 3 years, over the last 5 years, over the last 10 years, which is amazing news. And if we look at maybe a great alternative to VGT, one of the best alternatives would be QQQM. Now, we're not doing QQQM today because it is a little bit cheaper than QQQ, but QQQ has been a lot longer than QQQM. So we're going to take a look at that one just to compare to VGT. Now, QQQ is a great ETF, and as we can see, year to date, it is beating VGT. And there's a reason for that. It's got a little bit more diversity in it. It's got about 60% into technology instead of 99%. It's got some healthcare. It's got consumers. It's got so many different other sectors besides technology. But if we take a look at the 1 year, let's take a look at the 1 year. 1 year, VGT is winning. And 3 years, VGT is winning by maybe about 2%. That's not so bad. And we see the S&P 500 is lagging against both of those. 5 years, we can see that VGT is beating QQQ. And if we take a look at 10 years, like I said, VGT is going a lot higher than QQQ, and that's just showing you that VGT is just a great all-around growth ETF that can help them your portfolio grow in it larger. If you wanted some more diversification in growth, QQQ or QQQM could be that ETF to help grow your portfolio. Now, these are just some great ETFs to kind of boost your portfolio, to add that a little bit extra oomph into it. So what we're going to take a look at on the next part of our portfolio is creating something that brings stability, blue chips. I mean, just like in the Boggleheads 3-fund portfolio, we have bonds to help bring that stability and to bring income. And in this one, we're going to bring in some dividends. So we're going to have a dividend ETF. My favorite dividend ETF to kind of add to this portfolio would be SCHD. Now, SCHD is the Charles Schwab US 100 Dividend Equity ETF. It has a dividend yield of about 3.5 to 3.6% with a dividend growth rate of anywhere between 11 to 11.59%, which is amazing news because it is growing its dividend year upon year. It's got an expense ratio of 0.06%, which beats most of the other ones. So it's got a low cost, it's got a good dividend yield, and it's got a great growth rate. So let's go to Seeking Alpha, take a look at the holdings, take a look at the dividend growth rate in the dividends, and see how it compares. All right, let's take a look at Seeking Alpha. All right, so let's go to Seeking Alpha. We got SCHD right here, and as we can see, 1 year it's doing pretty good. Year to date, it's actually not doing bad at all. It's beating both the S&P 500, VGT, QQQ, which is great news. So that's just a good one to kind of have stability. And we can even see over here, people are saying it's a buy. All right, let's take a look at the holdings. Now, if we take a look at the holdings, we have healthcare, financials, consumer defensive, energy, technology, industrials, consumer cyclical. That is 7 different industries that have about 10% of this portfolio, which makes it a well-diversified ETF. Now, our top holdings are going to be AbbVie, Coca-Cola, Amgen, Cisco, Pfizer, Verizon, Chevron. These are some great holdings. Now, in the next month or two, SCHD is going to have a reconstruction, so it's going to add some holdings. It's going to take away some holdings. So that's just something to kind of look out for. But if we can take a look at the dividends. Now, if we take a look at this grade, it's got already an A+ grade. That's because it's got a great yield of 3.5%. The growth is about 12.5% for the last 12 months. 5 years, 11.59%. 10 years is 11%. And it's been paying a dividend 13 years while growing it 13 years straight. So we take a look at the growth over the last 10 years. We can see in 2015, it was 38 cents. In 2024, we're talking about 100, like almost $1 for that annual dividend. So it has been growing year upon year until, we got to this year. So for every share you have, you're going to get about $1. But that's going to be broken up 4 ways, and that was for 2024. And that's just great news. I mean, we see in 2024, it was at 3.64%. And that's just, look at this. It's growing 11, 15, 9, almost 10, 7, 20, 18, 11, 14. These are just some great numbers if we're looking at a dividend growth. Now, if we look at kind of the charting and we're looking at kind of how it is done against the S&P 500, and that's just a good metric to show. Let's make sure we have our metrics at total return instead of price return because it adds those dividends into it. And if we could take a look at maybe 1 year, it's not doing so bad against the S&P 500. If we took a look at 3 years, it is a little bit lagging the S&P 500. That's because it doesn't have as much growth. 5 years, not so bad. It's not lagging that much. In 10 years, it's doing, it's actually doing better than the S&P 500 over the last 10 years. That is amazing news because it is bringing up blue chip stocks. It's got dividend income to add to your portfolio, and it's got stability. So when we're looking at creating this 3-fund portfolio, we want to make sure that we have some growth, a core, and some stability. In case market turns happen, we need some stability. In case we want a little bit more growth when the market is on a bull run, we need that growth. And we just need that core just to kind of keep everything together. So if we really wanted to kind of backtest this against maybe the S&P 500 and the original 3-fund portfolio, we're going to take a back testing tool. Now, if we take a look at our back testing tool, let's record this. Let's come all the way to the top. Let's put some parameters on here. So I have the Boglehead 3-fund portfolio right here. I've got the Modern 3-fund, and I've also got the S&P. So right here, I got 60% into VTI. I've got 20% into U.S. international and 20% into bonds. I also have VOO right here. I'm going to break it down just into thirds. 34% to VOO, 33% to VGT, and 33% to SEHD, with 100% into VOO as my last market one. Now, I'm going to put a little bit of settings right here. I'm going to contribute we're going to start with $10,000, contribute about $1,000 per month for the next 10 years. And we're going to see how this looks. So let's analyze our portfolios just to check it out and make sure, is this modern approach going to beat the old approach? Is it going to beat the market? Those are some questions we're going to ask, and let's find out. So as when you see, the 3-fund portfolio is lagging the market about 3.8% annually. That's or for the whole time. Our approach is beating the market by 1.3%. That's amazing. And then, of course, you got the market, which is right on time. All right, if we take a look at kind of the holdings and seeing how much we're going to make, if we kept our portfolio and added that 1,000, we're going to make about 20,000. We're going to make about 80,000 more than the Bogleheads. We're going to do about 20,000 better than the S&P 500. And if we take a look at our best year is going to be about 35.7%, while the S&P 500 is 31%, and the Bogleheads is about 24.5%. Our worst year is 17.05%, while the Bogleheads is 17.55%. So our portfolio had a better year than their worst year, which is amazing news. And we also beat the S&P 500. The Bogleheads did beat the S&P 500 in their worst year, but we have beaten both of those. So our portfolio did not go down as much in one of the worst years, which was 2022. That's amazing news because you are not having such a market downturn as one that's got like lots of bonds in international. So if we take a look kind of at some of these metrics, and we can see that, our 5-year return is doing much better than the Bogleheads. It's doing much better than the S&P 500. Our 10-year return is doing good compared to everybody else. So this is a great 3-fund portfolio if you wanted to kind of set it, forget it, and when you get older, you can put more into SEHD. You can, if you're much younger, you can put more into growth. And this is just a great 3-fund portfolio that you can adjust throughout your lifetime. Now, this may not work for everybody, and there will be years where in international and bonds may kind of triumph over this. But there will also be years where our growth and dividends will kind of beat those. And this is just a great portfolio that you can set it, forget. If you want maybe some more small caps, you can add AVUV, which is a great small cap ETF from Advantage. And that just gives you some exposure to kind of those small cap companies. And if you wanted just a great alternative to SEHD, another great alternative could be DGRO or even FDVV. Now, FDVV is from Fidelity and DGRO is from iShares. These are two great dividend ETFs that can compete with SEHD. So let me know in the comments, do you like this modern approach? What is your 30-fund portfolio look like? And let's get down and let's continue to grow our portfolios. The market may turn every now and then. It could be down right now. It could be up right now. But when we're trying to create a 3-fund portfolio, we can't look at the market ups and downs. We got to continue to invest for every day and continue until, we retire. All right. That's a little bit about that. And if you want to find maybe one ETF to rule them all, I'll put a video up here to help you out. All right. Until next time, I'll see you.